So Sidin and team, we now go to fair value adjustments on contingent liabilities. We have looked at how you can adjust your inventory, how you can adjust your property, plant and equipment in the net assets of the subsidiary. Now we go ahead and look at contingent liability. So a parent company acquires a subsidiary at the start of the reporting period, and there's a contingent liability of 100,000. This contingent liability obviously works on the principles of probability. There's some event that maybe someone has sued you, and when you do your probabilities, you think that you might actually lose this case and pay that particular individual company so much. So you decide to book it in your financials as a contingent liability, which obviously you have to disclose in the notes. So saying a company acquires a subsidiary at the start of the reporting period, and there's a contingent liability of 100,000 kwacha disclosed in the notes to the subsidiary's accounts. The contingent liability is recorded at fair value within the workings at the end of the first year as follows. So this is what is going to happen. What they have done is that they have just put it in their financials, in the notes, as contingent liability of 100. It is not in the financials. So you have to do that. You have to show it in your financials. So this is how you're going to do. Remember that the net assets, or should I say, like I already explained, net assets is assets less liability. So if you have your equity part, yet there is contingent liability that you have to adjust, meaning that that equity component, which is equity shares and retained earnings, has to be adjusted. You have to subtract the contingent liability. So this is how you do it. So it is an opposite of property. If property is actually being adjusted upwards, meaning that it is going to come in as an addition. But for contingent liability, if you have to factor in contingent liability, it comes in as a subtraction. Is it okay?
This is okay.
Making sense, right?
Oh, that we didn't know him. Until you are told.
Yeah. So this is what it's going to be. Then means that in your financials, then now that contingent liability has to be booked. You have to show as contingent liability to increase your levels of liabilities. All right?
Great.
So I suggest if we can have time around 20, I'll give you a call so that we now look at other issues. This will be the last part on the group accounts and on consolidated financial statements. Then tomorrow we can then now start looking at the statement, the what you call it, profit and loss.
I see. Great.
So any questions, you have to, before you go, obviously you have to check out, you know what to do. So let me hear from you now.
To me, I'm very grateful because actually this one-to-one makes a lot of sense.
Hello, I can't get you. Sidney, I can't get you. Sidney, I couldn't get you. Hello, boy. Need to manage them class into the next 3 minutes. Where?